Good morning, good evening, good night, wherever you may be watching this transmission. It is I, Mike Martins, bringing you another very important article. Canadian variable rate mortgage rates are rising very, very fast. I haven't read this, and I don't need to read this, but I'm going to read it for you guys. But I want to tell you, I know when this is happening, there's only two things. Well, three things. Either A, the overnight rate went up via Bank of Canada lending rates, which hasn't happened. But I know this already. One is the bank is acquiring or accruing hidden costs, or they have costs that they're accruing and they're passing it to the customer. Or there's some sort of a fine or a fee or something's happening in one of the banks or one of the major banks, and why one bank raises their variable rates while others don't. Sometimes banks could be fined. They could be in courts and stuff with different cases going on, with malpractice, whatever, right? I don't know, right? But I know it's either that, it's not the overnight lending rate. It didn't go up. It's not, I don't think it's the banks themselves acquiring or accruing more fees in their own, or like overhead, paying more in overhead, or they get unexpectedly sued. Okay? The variable rates start to rise. Or thirdly, the banks just want to get more from the customers. I think that's what's happening. I'll take door number 3. So door number 1. Now, before I read this, guys, I haven't read this. I know what's going on here. Door number 1. The bank has accrued some severe debt. It's like a car insurance company, where if no one gets into accidents, they don't raise the rates, right, for everybody. But if someone gets into accidents, everybody's rates go up. Now, did the bank accrue some sort of legal costs, or the cost of operating is higher? Say door number 1. Door number 2. Is it basically the Bank of Canada raised their overnight lending rates, or they're already speculating they might raise it in the next quarter? Or door number 3, the banks are just passing on extra pay to play to their customers and making life a little bit harder for people because the banks want more money. I think it's door number 3. I bet you 100 to 1 it's door number 3. So let's read this. This is important, guys. This is so important because this is a sign that the banks are hurting. If the banks are hurting, they're either fully deleveraged and they have no liquidity, and or they've been playing the stock markets too long and they're starting to hit their pocketbooks. So, with our money, of course. Despite rock bottom borrowing rates, some Canadian real estate buyers are paying more. Bank of Canada BOC numbers show that variable rates on residential mortgages made a big jump. Even with the borrowing rates generally falling, variable interest mortgages are at a 6-year high. So even with borrowing rates generally falling, Variable rate mortgages. Variable rate mortgages are when a borrower sees the interest rate fluctuate. Payments usually stay the same, but the amount that goes towards interest fluctuates. If rates rise during the term, the borrower pays more interest. Well, obviously, right? It's like a bigger piece of the pie. It's like vice versa. If you have $1 million in your savings account and you're receiving 1.5% interest, you're getting $10,500 per year. If your rate goes up in your bank account with your $1 million to 5%, you're getting $50,000 per year for your money. So it's reverse for the bank too. Just giving people a little insight here. Interest and less principal. If rates fall during the term, borrowers may pay less interest and more principal. At the end of the term, depending on rates, you may have a bigger or smaller mortgage balance than expected. Uninsured variable rates are up over 26%. Ooh, I see where this is going. Okay, maybe I was wrong about all three doors. Uninsured rates made very large increases over the past year. The rate paid on new uninsured residential mortgages hit 3.74% in July, up 1.63% from the month before. The rate is now 26.35% higher than it was during the same month last year. Rates are at the highest they've been in the last 6 years and likely beat that record for some time. So rates are up. Wow. So they're up 1.63% from the month before. Holy smokes. So these are variable rate mortgages. These are variable rates where they a variable rate's very simple. It follows the trend of what the overnight rate is, and basically banks mark it up a quarter or 0.5% above what it could be, rate prime plus 1, prime plus 2, depending on where it's at. So, wow. So it is pushing the 4%. Well, it's going to push the 4% mark eventually. Wow. See, a lot of people started picking up these second mortgages in a variable rate mortgage for their second mortgage at 2%, and look where it's at now, especially if they bought and they have equity in they took the equity out of their house. Okay, insured variable rates are up over 36 points. This is insured now. If that wasn't fast enough climb, you should see how fast insured variable rates are rising. The typical rate, I was going to think insured always goes up higher or more percentage-wise than uninsured. It's always been like that for the last 100 years. Rate class reached 4.08% in July, up 2.25% from the month before, compared to the same month last year. This number is 36.45% higher. This is the highest rate insured variable rate borrowers have been taking out in the last 6 years. Holy smokes, it's past 4 points. Look at this one. It's reaching 4 points because variable rate uninsured mortgages are always slightly lower than insured mortgages. Oh, that's it. The article ends. Okay. Let's see what Better Dwelling has to say here. Variable mortgage rates are rising when the overnight rate hasn't moved. Yeah, that's bizarre. That's bizarro. Like I said, it could be those three things, right? In an environment where borrowing costs are generally falling, this number is rising. This number is rising is a little strange. Right there. It's weird. Some of this has to do with higher capital costs. Yeah, like cost of pen to paper to write a loan or to get the customer to sign a piece of paper. Or if they upgrade their security systems in their banks. I don't know, right? Which are passed on to consumers. However, some of it is just banks taking a bigger cut from the segment or a bigger cut from the pie. Oh, yeah. Thank you, Better Dwelling, for kind of throwing this out there and giving us a little bit of insight on if anyone took a first mortgage, an FMAR, if anyone took an FMAR, okay, with a variable rate, if you have equity, I would go to the banks and renegotiate something very quick. If rates go down in the next quarter, I would run to the bank and renegotiate your variable rate mortgage. I am not a professional. I can't read. And I don't know anything. Do your own research, okay? Thank you, Better Dwelling, for this beautiful article, as usual. And you guys have yourself a good night. What does this mean to you? Let me know. Thanks for watching.